My name is Sophia, and I'm a member of the NYU chapter at Scholars of Finance, and I'll be your moderator for today's session. Tonight, we are honored to have Frank Chen joining us for a panel on venture capital. Over the next hour, Frank will share anecdotes from his career so far, provide a general overview of VC, and talk about some of his daily responsibilities and skills. We will begin with a brief presentation, followed by prepared questions and an audience Q&A. Students, if you have any questions that come up, please raise your hand on Zoom and you will be added to a queue. Once called on, simply unmute your line, introduce yourself, and ask your question or share your thoughts. Also, we encourage everyone to turn on your video and be prepared to unmute your mic later as well, as we give our guests a warm welcome. Now I'll share a little bit about our panelists and then turn it over to them to get started. Frank Chen is an operating partner at the venture capital firm Andreessen Horowitz, where he works on the Talent X Opportunity Initiative, which aims to identify cultural geniuses and help them build enduring, scalable, and large businesses around their cultural breakthroughs. He was previously on the deal and research team at the firm, and since 2009 continues to be responsible for finding and evaluating great entrepreneurs and companies. Prior to Andreessen Horowitz, Frank was the vice president of strategy for HP Software, where he helped the company understand and act on changes resulting from the rapid enterprise adoption of virtualization technologies across servers, networks, and storage. Frank joined HP Software through its acquisition of Opsware, where he was the vice president of product and user experience for a broad set of Opsware's data center automation products. Frank holds a BS in Symbolic Systems from Stanford University, where he graduated with distinction. Everyone, please unmute your lines and give our guest a warm round of applause. Or a clapping emoji.
Thank you. It's great to see everybody. And Sophia, did you want me to just launch right into things? Thank you for the introduction.
Sure. Go ahead.
All right, well, I happen to have a few slides that I thought I'd use to anchor the conversation, but this hour really is yours. I'm honored to be a guest here. I've known Ross for a couple of years now and sort of honored to be one of his mentors. We get together on a regular basis for some very long walks where we talk about the startup that he's building, Scholars of Finance, and sort of his vision for the world. And so I've always been a fan of Ross's, and I'm glad to be able to talk to you guys about what venture capital is. I really wish somebody had explained it to me when I was an undergrad, because I had no idea. So hopefully this is useful for you. So why don't we get right into it? I want to spend maybe 10 minutes talking about what VC is in the universe of finance, and then sort of a little bit about how we pick companies, and then I'll just throw it wide open for questions. So without further ado, let me sort of talk about how the thing works and anchor it, as I like to do, in a little history. So the very first venture capitalist that we would recognize as such was a French person who relocated to the United States. And he started this Advanced Research Development Corporation as the very, very first VC, and made sort of one of the very first and most awesome tech investments of all time in a company called Digital Equipment Corporation, or Digital. Nobody knows that company today, but at the time it was one of the most important computer companies around, similar to IBM and so on. And the sort of thing that made it really interesting is that, like, if you compared this way of sort of getting a company going compared to all the other ways before it, all the other ways before it were you would go to a bank and try to get a loan. So somebody like, you know, JP Morgan trying to start General Electric would go to sort of a banker at the time, JP Morgan, right? So Thomas Edison would go to JP Morgan and say, I'm starting a company, would you like to invest in the company or give me a loan, right? And the problem with that for a broad swath of companies is the first question the bank would ask is, gee, how long have you been in business and what's your operating history, and show me like 4 years of your revenue. And for these brand new companies, like think about, like, you're Thomas Edison, you just got the light bulb to glow. And now you're going to build a company around it. And you need to build generators, you need to like lay wires, you need to make hundreds of millions of these light bulbs. Like, you don't have any revenue, you don't have any operating history. And so the banks turned out not to be good places to, you know, sort of make loans into these companies. And so into that sort of milieu arrived George, and he was like, look, we need to fund higher risk things than the banks will fund, right? Which is, we need to fund a company that might actually just fail. And if you talk to a bank loan officer to this day, they don't like the idea of companies failing, because like, how do they make their money back? And so venture capital was sort of the asset class, if you will, that existed to take high risk in companies. And what they would get in return is they would get an ownership percentage of the company. And they operated very differently from banks. Banks are like, gee, if I make you this loan, how quickly will you repay the loan, and how much interest will you give me, right? That's sort of the way the bank works. Venture capital says, gee, I'm going to invest in a bunch of companies, and some of them we know will just outright fail. And in fact, if you look at sort of modern venture portfolios, roughly 30 to 50% of companies that are in a venture portfolio you will never hear about. And from the investor's point of view, they lose all their money. And so if you might be thinking, gee, like if you had a portfolio of 10 companies and 5 of them lost all your money, how in the world do you guys make money? And the answer to that is, we make money because one of the companies in that portfolio, we're hoping, hope, right, becomes Facebook, or it becomes Uber, or it becomes Airbnb. It becomes this name brand that everybody understands. And what you'll do when you have ownership stake of a company that you got in early at, you will make 10, 50, 100, 200 extra money. And that's basically how we stay in business, which is most of our companies fail, but the ones that don't, we're hoping for big outcomes. And that's sort of like the genesis of venture capital. The way it works is we go and we raise money from a set of what are called limited partners. This is where our capital comes from. So if we put $10 million to work inside Facebook or Airbnb or Pinterest or Lyft or any one of these companies, Clubhouse these days, where does our money come from? It comes from these sources. In fact, most of you are going to universities that have endowments. A lot of the top endowments actually put money into us. Alongside that, there are sovereign wealth funds. So the country of Singapore, they have basically mandatory retirement funds, which all workers contribute to. So it's not elective like it is here, where you can choose to put money in your 401k or not. In Singapore, like they just automatically collect it for you. And then that endowment money gets invested in across a variety of fund managers, including venture capital. We've got foundations, the Hewlett Foundation, the Packard Foundation, et cetera, et cetera. And so all of these people invest money in us. We are one of many venture capitalists. And then we make startup investments. We go and try to find the very best startups to put money into, knowing full well, as I described before, like we'll lose our money in most of them. Most of them will fail because it's very high risk. Now, the good news is it's also very high reward, which is like if you owned 10% or 5% of Facebook when it went public at a valuation of $50 billion, you would have a lot of money to return to your investors. And so that's basically the way it works. What we're looking for kind of depends on the stage in which you are investing. And so let me say a little bit about this. The way modern tech companies and a lot of other companies also, consumer packaged goods companies, get funded is they get funded in a series of steps. And we give those steps names like the seed investment or the Series A investment, the Series B investment. And each one of these steps implies a certain check size and a certain ownership. In other words, how much are you buying of the company at that point in time? And you have specialists at all of these stages. We happen to be a big venture capital firm, and so we invest kind of across the entire life cycle of companies. And if you look across our teams, we kind of look for slightly different things. At the beginning, we're looking for great founders building a product that people love into a big market, right? That's all we can look for because there's no operating history. And then as the company matures, as it gets later and later, so if you think about Airbnb, a Series C investor in Airbnb is starting to look at revenue and revenue growth and what's the cost of getting a new host online, how much commission can we expect to make from that host over time, right? So it's a much more financial analysis all the way up until they are a public company, And then there are public market investors like you and me and ETFs and mutual funds, so on, who buy and sell stocks in these public companies. And that is mostly a numerical analysis, right? Gee, what is this company worth? How much revenue? What should the multiple of revenue that I'm paying for this stock be worth, and so on and so forth, right? So the criteria for how you decide to invest sort of changes over the time as the company matures. So roughly speaking, you fund founders building a product, and over time that changes to I'm investing with the expectation that my investment will get more valuable, and it's kind of a spreadsheet exercise, which is I expect the company to grow their revenue 50%, and therefore the stock price should rise, some proportion of that. So does that make sense to everybody? So that's sort of the way. Contrast this with how we have, as a society, funded big, hairy, audacious projects. This is not the only way to fund something, right? So if you think about how we have funded the development of the lunar mission, like this is not how we funded it. We didn't give NASA a little tiny bit of money at little bits, right, and hope that they made it. What we decided as a country, thanks to JFK, is that we were going to invest a sizable fraction of the federal budget into science spending, and NASA in particular, with the aim of putting a man on the moon. And at peak, that was something like, I don't know the exact number, but something like 8% of GDP went to NASA. Like, it was a massive investment. It's also how we funded the atomic bomb project in the United States. So this is not the only way to fund high-risk ventures, but historically, what we've proven ever since George Diderot made his first investment in DEX, so that was in 1964, so we've been doing it now for 50 odd years. This is a very, very reliable, well understood way of attracting capital that can take risk into companies that could end up being very, very big. Okay, so that's basically how it works. And then I'm going to sort of speed through the next couple slides, if I can advance them, to give you a sense. Oh, before I leave that, I'll just sort of give you a play-by-play of like exactly how did the seed ABCD funding history play out for Facebook. You guys still know Facebook, right? I know everybody's on TikTok and Instagram, but like there once upon a time was this cool social network called Facebook that all the young kids are not on anymore, but us old folk, we still use Facebook. So for those of you that use Facebook, this gives you a sense of sort of how much money was invested at each one of these sort of steps in Facebook's financing history. Okay, what do we look for? And I'll spend 5 minutes on this and let's throw it open for questions. So begin to think about your questions. So one, we tend to get attracted to big markets. In other words, how much of a problem is this company trying to solve? And so a rough proxy is we're looking for companies that in a very short amount of time will be selling $100 million worth of stuff a year, right? So if you can do that in sort of like 3 to 5 years time, then that's great. And then 100 million leads to 500 million, leads to $1 billion in revenue. We need to fund things that are going to solve a lot of people's problems rather than a very narrow slice of people's problems, right? It's a big enough market. The second thing that we look for is we look for ambitious founders who want to build independent companies. And I have to say, like on the scale of human difficulty, this is one of the most difficult things on the planet to do, which is go from 0 to 1. That's what Peter Thiel would call it in his famous book. You had nothing, and then you're selling something, right? So Thomas Edison building the electrical infrastructure. Elon Musk building Tesla. Like there was no electric car company and now there's an electric car company. Like it is one of the most difficult things to do. You have to be some combination of ambitious and shrewd and high EQ and awesome amounts of grit, stick-to-itness, and just the right amount of insane, because like you are predicting that people on the planet will be doing stuff that on the face of it looks very unlikely. Right? Like that we'll all want electric cars, unlikely. Or, you know, my two favorite examples in our own portfolio are Lyft and Airbnb. Lyft and Airbnb are solving a problem where people do exactly what your mother told you never, ever, ever in a million years to do, which is to get in a stranger's car and go to a stranger's house, right? Like that's just weird. But these entrepreneurs saw that like, not only was that not going to be weird, you would prefer it to getting into a cab. But when Lyft and Uber and Airbnb started, it was not at all clear like that was going to shift culturally, that like what your mother warned you against and never should you in a million years do that would become the default way you go on vacation and get from point A to point B inside a city, right? Like it's weird. So you need like entrepreneurs who can see beyond the weird. Another thing that we look for is product market fit, which is sort of VC lingo for, all right, there is a need. You have the need to get from point A to point B, or you have the need to stay in a thing that looks like a hotel room. Then we look for, does the product that the company has designed, does it solve that problem, right? Is Lyft the right answer to that, or is Uber the right answer to that, or is Airbnb the right answer to that? And like, look, Airbnb sort of was not the very first company that let people rent out their properties. There's lots of others, including some that still exist to this day, like VRBO. But like when you think about staying places, like you could probably think Airbnb, right? Which means that it probably had the best answer, the best product that fit the need of the market. And so that's what we're trying to predict. Who's got the best product? Another thing that we look for that may not be sort of as obvious is we look for sort of founder to product fit. In other words, are these people the best people on the planet to work on this, right? Have they worked on something related? Have they built something before that's like this? Or have they thought through the problem so carefully that they will out execute everybody else who is going to be in this space? Because make no mistake, when you venture fund something, there will probably be 10 or 20 or 30 companies that look exactly like it. In fact, there was a venture outfit in Europe, that was their whole investment motion. They would wait for an idea to get invented in the US or China. Then they would fund the European company building the exact same product. And, you know, look, that worked for a little while. But it turned out that a lot of the Chinese companies and the US companies just got big enough that, you know, the native competitors, the local competitors got overwhelmed. And a lot of that has to do with the founder product fit, right? Which is the person who thought of the idea and thought about it most deeply and built the best product actually ended up taking the market. So important to find founder product fit. We like things that have a durable defensive moat. One way to think about it is if you tomorrow, Amber or Jenny or Sophia, like wanted to wake up and say, I'm going to build a startup that competes with Airbnb, how hard would that be? Right? And if you thought about it for a second, you're like, man, that'd be pretty hard because like all the hosts are already there. And all the guests who want to stay at these things, they know to type Airbnb into their browser or like fire up that app. And so I would have to replace that behavior. We would call that a very durable defensive moat. The brand is powerful. The hosts that have been onboarded, the pricing that they've set for those hosts, the guest safety policies that they have refined over time, like all of that would need to be duplicated. And arguably you'd have to do that better. And so that is a very durable defensive moat. So one way to think about durable defensive moat is how much would it cost to build a better version of Airbnb or Lyft or Pinterest from a cold start? And the bigger the number, the more durable the defensive moat. Okay, we also have to look for businesses that are very attractive as businesses. In other words, there's a little jargon on this chart that we often look at. LTV stands for lifetime value. How much is a customer worth to you over the lifetime of your relationship with them? And then cost of customer acquisition. What does it cost to get a customer? So if you've ever gotten a flyer from AT&T or Comcast saying like, please sign up for my fiber or broadband service, right? You can think, okay, that just cost them something. They had to buy my name, they had to print the postcard, they had to mail it to me. They're expecting that all of the money it took to get you that little postcard or email or whatever is going to be worth it, because if you switch and become a Comcast customer, your lifetime value to them is thousands of dollars over the time that you subscribe with them, right? And so everybody is doing this math, and we need to do that math too, right? Is it a really good business that makes sense? Another thing that we look for is fast growth. Like if you want to be a slow grower, right? Like you grow 2% year over year or something like that, venture is not for you. Venture capital is attracted to companies that are growing very, very fast because typically they're new to a space and they're basically attracting customers. And so if you think of customers or companies like Google and Facebook and Lyft and Uber and Airbnb, all of these things seemingly came out of nowhere. Today, you might say that about Clubhouse. And then like, it felt like one day it was nothing. And then the next day, everybody was in a lift, or everybody was staring at an Airbnb, or everybody's in a Clubhouse room. Like I'm kind of doing this on Clubhouse, right? So you look for very, very fast growth to make your investments. Okay, I think that probably is, oh, let me just sort of share one factoid. This goes with most companies will fail, but you're hoping that your top companies make up for it. This gives you a sense of how concentrated the returns are in the very top companies. So we did this analysis over a couple years. I can't remember. Oh, it's on the slide, 1998 to 2000 odd, 8 years. And the top 15 companies for each year generated 82% of all of the value of that class, right? It is an extreme, what we call fat head business, which is only the top dozen or companies or so matter. And then everybody else like doesn't really drive the returns, right? Extremely, extremely fat head. Okay, so I think I want to pause there and then probably switch to questions. So why don't we do that? You guys can still hear me okay, right?
Yeah. Before we go into audience Q&A, there are some prepared questions that we'd like to cover for about 10 minutes. And then whoever has a question, they can raise their hand.
Good, let's do it.
So before we jump into your experience in venture capital, just to expand a little bit on the presentation and what you look for in companies that you're investing in, on a technical level, can you talk a little bit about how the investment analysis process in venture capital differs from other sectors in the private markets, such as private equity?
Yeah, so the way to think about it is when we meet a company, it could be as early as their two founders, they're living in a garage, they show us a pitch deck and they have their pet dog with them. Like that's all it is, right? And so if you compare that to like what a private equity company has, private equity investor has to invest, they have like a data room filled with like huge spreadsheets of operating income, expenses, projections, going back years and, sort of projecting out years, right? And so we can't do a financial analysis because all we've got is the founders' backgrounds, their dreams, their idea, and their pet dog, right? And so what we're doing is we're making investments on very, very limited data sets. And so that's sort of one difference. Another difference is, we are thinking about our position in that sort of stage of investments, right? Which is, there are investors that specialize in the rounds before us. There's investors that specialize in the round after us. And we're kind of thinking, if I put in, say, $10 million into a Series A company, can I get it safely to a Series B investor, right? Whereas a private equity company might be, private equity investor might be thinking, can we get to an IPO with the amount of money I put in? Or can we get it safely sold to a big company, right? So we're thinking as Series A investors, can we get it to a Series B investor? Will they find it attractive? Whereas, sort of later stage investors are thinking, can we get this company public? Now, obviously, we're thinking about like going public as sort of an outcome. That's our fond aspiration for all companies. But really, sort of the local goal is $10 million. Can we get it to the next investor? And so the way we break it down is $10 million means this much hiring. It means this much marketing. It means this much product development. And taken all together, can we get the company to an attractive business place, right? In terms of revenue or engaged users or app downloads or whatever that is, such that the Series B investor will say, I'm good to invest my amount of money, right? And so that's sort of a little different. We're thinking about it in terms of these deliberate stages. The visual I always like is it's kind of like Tarzan that is swinging from one vine on a tree to another vine, right? And so think of every vine as a particular investor in this sort of universe of investors. And Tarzan's job is to get from one end of the forest to the other end, one vine at a time. And his job is to sort of get the business into a position where it looks attractive such that the next vine is a solid, graspable thing. So those are a couple differences between sort of how we invest and how later stage investors think about the world.
It's very interesting. And so for you working at a venture capital fund, what does your day-to-day look like?
Yeah, so my day-to-day, think of it, it varies a lot, but if you were to sort of zoom out to the month and basically say, draw the pie pieces of your time, I would say this. I would say probably a quarter to a third of my time is meeting with new entrepreneurs who are fundraising, right? That's what we call deal flow. It is, somebody who wants to raise money. And then a third of my time is probably doing deep diligence on a subset of those companies. The ones that I really want to learn more about, I'm spending more time with them. I'm interviewing customers. I'm interviewing people who work there. I'm interviewing people who used to work there. That turns out to be a great source of diligence. Why did you quit? Why did you leave? Is it something about them, or did you have a better career opportunity? Those tell you a lot about the state of the company. So that's what I call deep diligence, right? So we had a third that was meet somebody for the first time, and a third on deep diligence of the subset of companies that I want to learn more about on the way to making an investment decision. And then a third is sort of other. And other, I mean, I'm building relationships with people who will refer deals to me. I'm writing content that will publish as a blog post or as a YouTube video that will attract entrepreneurs. I'm spending time with the companies that I've already invested in, either as a board advisor or as a formal board member, right? I'm giving formal advice to founders and founding teams. And then, there's overhead. There's like, make sure I understand the rest of the investment my partners are making. Make sure I understand the new hires that we've made, right? So just normal workaday stuff. But 1/3 is meet new companies, 1/3 is deep diligence, and 1/3 is help make the company successful, plus make sure I understand what's going on in my own firm.
Awesome. Are there any projects you've worked on that you can tell us about that have been particularly challenging or interesting? And what was the process going through that?
Yeah, maybe I'll share a few stories from the second pie segment, which is deep diligence, which is, as I mentioned, we have very little data to go on to make these decisions. And a lot of our decisions really come down to people decisions, which is this the team that we want to back? And so a couple interesting stories from trying to figure out if this is the team that we want to back. So we do a lot of what are called backdoor references, which is to say, we just go ask people we know, hey, what was it like to work with them? Or what was it like to work for them? Or what was it like to invest in their previous company? Or what was it like to be their professor, right? So backdoor reference checks. This turns out to be critical to our decision-making, which is, the funny story is, the entrepreneurs will give us front door references. They will say, if you want to understand me better, please talk to these 3 people. And what happens with front door references is exactly, they do what you would do, which is, well, meet my mom, she thinks I'm awesome, right? And then meet my professor who gave me an A+ in my class. She thinks I'm awesome, right? And so we will do those front door reference checks, but we kind of discount them because they're carefully cherry picked. In fact, if we don't hear something along the lines of, this person walks on water from a front door reference check, something's wrong, right? Because that person was vetted and prepped and coached and has every incentive of the world to say good things about that person, right? So where all the nuggets of actual data are with the backdoor reference checks, right? Which is the people who didn't know we were coming and we're trying to figure out. And so 2 fun stories from people that I did backdoor references on and from who. So I was doing the backdoor reference on the founding CTO of Airbnb, and he had recently gotten engaged and was looking forward to his wedding. So I called his father-in-law to be, because I figured that guy did a lot of diligence, because it's way important to like decide to give your daughter away in marriage than it is to put $10 million in the company. Like, that's way more important. So that guy, I bet you, did diligence, and it was awesome. Father-in-law spilled it all. That was great. Backdoor reference. Another backdoor reference that I did that was super helpful was one of our founding CEOs played college football and was a linebacker. And so I called his coach. And in college, you develop a special relationship with your coach because it's so time consuming. And when you play at a high level, you spend a lot of time with your coach. And then college coaches, more than professional sport coaches, they're this interesting time in life where like you become not just sort of a sport and skill coach, you kind of become a life coach, right? You're coaching character as much as you are coaching like how to be a linebacker. And so that reference was super, super valuable because I got real insight into the character of somebody. And that turns out to be hugely important, right? Which is, how likely are they to commit fraud? How likely are they to stick with it if the going gets tough? How likely are they to bounce back from adversity? All of these things are as important to whether a startup's going to be successful as, can they write good software, or can they hire good salespeople, right? Like the character of the person running the show, right? Which is going to reflect itself in the company's culture, in the hires they make, in the sort of the behavior during difficult situations. And like, look, in the last year, all of our founders went through like the hardest thing that you could imagine, right? Through the pandemic. And, you know, like being able to predict how are they going to respond to adversity like that becomes a hugely important part of our job. And so those are just two fun like stories of like the out of the box thinking that we need to do to try to figure out who are these people and do we want to back them.
Thank you so much for those stories. They were very interesting.
Good.
I think we have time for one more prepared question, and then we can open it up to the audience. So if anyone has any questions on Scan, feel free to raise your hand. I want to segue a little bit into your role on the Talent and Opportunity Initiative team. The team is described as, or the project is described as a system that discovers and supports cultural geniuses. Can you talk a little bit more about this initiative and also the role that venture capital plays in supporting cultural breakthroughs as it is defined on the website?
Yeah, for sure. I'm glad you asked. So if you think about Andreessen Horowitz and you're in the tech ecosystem, what you will think about is sort of tech investing, right? It's Facebook and Twitter and Clubhouse and Lyft and Airbnb. These are technology breakthroughs. They're using software to eat the world, as my famous partner Mark wrote in a Wall Street Journal op-ed, right? And we still use that phrase, software is eating the world. So that was sort of the first chapter, if you will, of Andreessen Horowitz. The Talent Times Opportunity Fund is doing something fundamentally different. Instead of looking for tech breakthroughs, we're looking for cultural breakthroughs. What are the cool kids wearing and eating and putting on their face and talking about that could become big cultural mainstream activities? So we're trying to find entrepreneurs who have, you know, built a product that has a super loyal following amongst a very small set of super fans that could go cross over and become something that we're all doing, or we're all wearing, or we're all eating. So that's what we think of as a cultural breakthrough, which is you start with a small group of super fans and you build a product and it kind of crosses over. And if you think about like that, like what are examples of sort of things that are beginning to cross over? Cryptocurrency itself is beginning to cross over, right? So for a while it was only nerds on weekends, basically Bitcoin mining, and then all of a sudden Beeple sells $6.4 million of JPEGs in a non-fungible token. So if you don't know who Beeple is, go look him up, Beeple. We may be at the cusp of a mainstream revolution on artists creating digital art and maintaining ownership over them, instead of like the JPEGs getting, you know, copied and pasted onto everybody's hard drive. So that's a cultural breakthrough. Another cultural breakthrough is basically using the internet itself. In the early days of the internet, it was all very strange behavior to log on and talk to people. And that became mainstream. Using PCs was sort of a, you know, sort of a, these days, you know, what are people doing? Keto diets are extremely popular and look like they could be crossing over. So we funded a company basically that made a donut that is keto friendly, high protein, low glucose, low glycemic index, right? Gluten-free, the whole 9 yards, right? So it is the halo top of donuts, if you will. So that could be a cultural breakthrough. That's the type of company that we're now looking for in the Talent Times Opportunity Fund. So instead of technology breakthroughs, cultural breakthroughs. And when you set out to look for cultural breakthroughs, it turns out that like you will over-index to founders that are sort of outside of the mainstream networks. So instead of Stanford, MIT, Harvard kids, it's sort of people who might have dropped out of college, right? But live in Atlanta or Detroit or LA, where a lot of memes get born, right? And they basically manage to develop a little following of super fans. And then, you know, they'll have this moment where there's a meme that goes viral, and then all of a sudden it crosses over into the mainstream. So what we're trying to do is find founders who are using the latest tools to reach very broad audiences for the products that they've built. And then we come alongside them with a small investment. We train them how to build big businesses. And we hope that in 20 years' time, when we look back at it, that we will have been a very important brick in building this entire house to support people who are traditionally underrepresented in sort of venture financing, right? African Americans, women. It turns out that those two groups have been disproportionately active in creating the cultural breakthroughs of our time, right? What we eat, what we wear, what we put on our face, like tends to get created by people who are sort of underrepresented. And it's our mission to find them and help them build big companies.
So thank you, Frank. That sounds so interesting and very unique. We now have about 20 minutes for audience Q&A if anyone has any questions. Okay, Benjamin, can you unmute? Sorry.
Yeah. Hey, Frank, thanks so much for coming to speak with us. Super interesting and really appreciate you taking the time. I'm Ben, I'm a current junior at Yale, and I'm actually really curious as to what your take is and maybe how you think about, and also how Andreessen Horowitz thinks about venture investing in emerging markets, places like the Middle East, Africa, Sub-Saharan Africa, and whether or not your diligence and screening process differs, and whether or not, and also how it differs as you approach maybe investing in areas where there's more asymmetric information flows and more difficult screening processes at the earlier stages.
Yeah, that is a great question, Ben. So let me sort of offer a few thoughts. So first, the person who probably knows most about this question I'm going to sort of point to is a guy named Christopher Schroeder. And he wrote a book called Startup Rising, and it is all about sort of emerging economy. And he sort of leads with MENA, which is Middle East, North Africa, that region. And he is just as bullish as they will come on the future of the region. And so like, go read Chris Schroeder. He has a newsletter. He's on Clubhouse a lot. So if you're interested in this topic, definitely go listen to Chris. He's fantastic. He's a great friend of the firm and very thoughtful on these topics. So thing number one. Thing number two is, look, you would expect the world to get increasingly flat as information technology and software makes it easier and easier to spread best practices around regions. Having said that, today we are still very regional, which is, you know, Silicon Valley gets, I don't know, 60 cents on every dollar of venture investing. You would expect that over the coming decades that would flatten out, and the pandemic probably hastened it. Which is, if you think about the regional supercenters outside of Silicon Valley that are like great ecosystems, you think of Austin, you think of Miami, you think of Seattle, you think of New York, you think of Silicon Beach, Malibu down in, you know, where Snapchat is in LA. So, you know, there's at least those 5 cities that look like, you know, they are going to mount a serious challenge. And, you know, sort of there's also sort of regional politics here at work, which is, you know, cost of living in the Bay Area is very, very high. The political system in the Bay Area is very hostile to startups, right? Which is sort of ironic, which is like, that's where the tax base comes from. But like, if you look at the set of policies that local Bay Area politicians are putting in place around housing, that type of thing, around like, you know, how friendly are they to startups? They're very unfriendly. Whereas the mayors of Austin and Miami, San Diego, you know, have put up their hands and say, hey, look, if you're tired of the board of supervisors at San Francisco terrorizing you out of the city, please come. No income tax, no property tax, tax breaks, right? And so you would expect all of those motions to sort of even sort of the playing field out over time. But what's needed is there needs to be sort of enough of a sort of ecosystem in those cities to get them to sort of catch. You need enough entrepreneurs, you need enough capital, you need enough ambition in each city, and you know, it's taking a while. But I would say the pandemic probably moved this whole epic forward 10 years, right? Which is like, Miami wasn't really on the map before the pandemic, and now like I know dozens of people who have moved there. So you would expect the all the regions, including outside the US, to sort of get a big jolt, because you don't have to live in a high cost of living. Like the bargain that was struck is, I will go try to buy a house in the San Francisco Bay Area because if I'm trying to build a tech startup, like I have to be there. I think the I have to be there-ness is going to drop, and Austin will look nearly as good, or Seattle or something like that.
Thank you so much. Super interesting.
Yeah, for sure.
Alex?
Yeah, hey Frank, I'm Alex. I'm a sophomore at NYU. So I have a question about your durable and defensible moats. So I understood the example you brought up about Airbnb. If you were trying to build a competitor now, be very, very difficult. But if you're looking at, say, like Airbnb at the seed or Series A stage, you know, at that point is probably a little less defensible or seems less durable. So how would you assess whether long-term they can build that moat over time?
Yeah, so a couple things. One is you have to have sort of a business plan that allows you to get to that stage, right? Which is, have they thought about the stages that they'll need to go through, and sort of, is that sort of the right way of prosecuting the business, right? So in a classic marketplace like Airbnb, you have to go build the supply, because if you don't have the supply, you don't get demand. And then where most marketplace companies die is they get the supply, because like if you're a host, of course, you get money raining from the sky. Who wouldn't want that? You'll get the initial demand because there'll be new people who try anything. Where most marketplace companies die is basically after the early adopters, you have to reach a mainstream audience, and the cost of customer acquisition for that mainstream audience is very, very difficult to get. And so you look at a company's ability to sort of survive that particular storm, and you try to sort of predict, is this the team that can get past it? Right. So that's one thing, is like, have they thought through the business? Do they know where they're going to get stuck? And do they have ideas of how to unstickify themselves? And then the second thing that you have to do is you have to sort of imagine, like, if they succeed, how durable will the moat be? As opposed to, look, there's always 1,000 reasons not to invest in a company, right? Because it's all risk. They have no operating history. They have, like, you know, when we invested in Airbnb, they barely had 1,000 units, right? And so, like, there's just not enough data to go on, which is, it's as likely that they get to 10,000 hosts and then there are no more. It's just too weird, as it is that they could get to 100,000 hosts and then 1 million hosts, right? Like, that is highly, highly uncertain. But you have to ask yourself, if they got to scale, would there be a defensible moat, right? And so there's a bit of imagination that you have to exercise there.
Thank you.
Yeah. Sure.
Chad?
Hi, Frank. Thank you so much for taking the time to speak with us. I'm Chad. I'm a junior at NYU. And I was wondering,
NYU, represent.
Yep. And I was wondering, as like Mark Andreessen said in one of his like older essays, that a great market will pull a product out of a team, and like kind of the importance that he put on finding a great market. How do you think about that with a company like Lyft, who actually like expanded the total market, where maybe the cab market wasn't as large or wasn't as like viable necessarily, but as Lyft came into the market, they actually expanded the TAM of that area? And can you have any signs to predict that at like the seed or the A?
Yeah, I mean, it's very hard. We obviously talked about it, which is, you know, we often do this math. Look at all cab revenue, right? And is this a subset of that? Is Lyft and Uber going to be half of that? Or is it going to be as big and it's going to eat all the cabs? Or is it going to be bigger than that, right? And basically what we do is, let's make the argument that it's going to be bigger than that. What would need to be true? What would need to be true is the pricing was attractive enough that more people who like didn't get into cabs would get into cabs because they could afford it. What also needed to be true is that it needed to be more convenient, right? The overhead of flagging a cab down or calling and waiting, like that needed to be sort of frictionless. We also needed to believe that the supply of drivers could be bigger than cabs, right? Which is like, look, if you wanted to be a cab driver in London, you go through years of training, because London was designed for horses. It was not designed for cars. And like finding your way through London on anything was nearly impossible. In fact, they've done brain studies on the people who mastered the ability to drive in London prior to GPSs. Their brains are physically different. In order to represent the map of London in your head and actually get from point A to point B reliably, you have different brain architecture than a normal person. But Smartphones changed all that, which is all of a sudden you didn't need to know how to get anywhere because the phone told you. And so you had to believe that like the supply of drivers and the tools that you could give them would sort of expand. And so you kind of make arguments, right? You sort of say like, this is what it would mean to be, what would have to be true for the TAM to be enlarged. And then let's assign probabilities to that. What's the probability that GPSs eliminate the need to know how to get from point A to point B? Well, we said like, 95%, 98%. It's nearly certain that like nobody needs to know how to get from point A to point B because the GPSs are so good. What's the probability that the pricing will be low enough that more people try it? And we said, probably like 60%, right? And so you do all of these expected outcome analyses. And you realize, look, you have to have a measure of humility on these things, which is your projections are probably going to be wildly wrong, but at least you want to have the arguments of like what would need to be true for this to be a bigger addressable market than all cabs today. We did the same thing on Airbnb, which is like, look, at their growth rate, should we think of this as 1/3 of all available hotel rooms, or should we think of this as like 10x the supply of all available hotel rooms, right? Like, how do we think about it? What's the real addressable market? And so you have to basically do all the kind of modeling and making the arguments.
Thank you.
Yeah, for sure.
Awesome. Juliana?
Hi, thank you so much. I just had a quick question. I'm a sophomore at Brown, and I'm actually from San Francisco, so it's funny when you're talking about the Bay Area. But for a company that comes to you that's kind of like in a specific industry that is kind of like complex to understand, so say there was like a cancer company coming to you and they have a very specific technology, do you hire people to help you understand what they're doing, or is it something that you have in-house?
Yeah, that's a great question. To the extent that we can, we try to have that expertise in-house, which is we will shy away from investments where we don't really understand it. So even though we're the software eats the world people, there are types of software we won't even invest in because we just don't have the expertise, right? So one of the areas that we are not active is there's software that helps chip designers design chips. That's software. Technically, software is eating the world. You think we'd invest in that, but we just, enough humility. We don't understand enough about that space to want to make an investment. So for cancer therapies, we have, MD PhDs on board. We have people who have developed drugs. We have people who have worked inside the FDA to do sort of the clinical trial approvals. All of these people are either in the firm or a phone call away, right? So what I sort of train the team on when we're trying to do this type of diligence is who do you know? What is your list of subject matter experts? And if you are going to invest in a CRISPR company, for instance, do you know Jennifer Doudna? And if you don't know Jennifer Doudna, she was one of the co-creators, won the Nobel, should win the Nobel Prize, right? Or I think did win the Nobel Prize for discovering CRISPR. Like, how do you get to her? And how do you make sure that she returns your call? So if they're not in the company, we need to be a phone call away. And like one of the things that we sort of measure for our people is how many people like Jennifer Doudna do you know that are going to be relevant for making these types of decisions.
Thank you.
Yeah. Sure.
Benjamin again.
Yeah, honestly, super interested because we've heard a little bit about, I guess, what you look for in a company from sort of an investor mindset, what you look for in a founder. I'm really curious, like your take on what you look for in an investor, someone like us who might be interested in breaking into VC and how we can sort of position ourselves now for that path later on.
That's a great question. And I've sort of hired the bulk of the people who have joined us as junior investors over the year. So so here's what I look for. In general, we look for people who are deeply, deeply embedded in the startup community, right? Which is, if I ask you, what are your favorite 3 startups? You're kind of doing this mad exercise of, well, I know 100 of them, but you like know the answer to the top 3, right? And it's not because those are the only 3 you know, right? Which is, in your spare time, you are talking to startup founders and reaching out to your friends who have built startups and reading TechCrunch and Hacker News and all of the sort of things. And your information diet reflects sort of a startup mentality. And so you just end up knowing a ton of them, right? So that's one thing that we look for. Another thing that we look for is sort of broad intellectual curiosity. We look for people who are like curious about lots and lots of things and love learning, right? So one of the questions that you would get during an interview would be, What's the last thing that you learned? How did you learn it? How quickly did you learn it? What was sort of the most, like what steepened the learning curve the most as you learned that thing, right? So we look for sort of people who are just genuinely curious about the world. Third, we look for people with operating experience, and operating experience is distinguished from investing experience, which is operating experience means you've worked in companies, right? And like if I were to draw the ideal 2x2 matrix of the operating experiences that you would have, sort of visualize this 2x2 matrix. On one axis, it's big company, small company, right? Because small companies give you the adrenaline rush of knowing like you're trying to build from 0 to 1. You understand like there's no resources, there's no scale, like you're trying to get your first product to stick. And then a big company, you can scale, right? Airbnb, people want it, but like getting from 1,000 hosts to 10,000 hosts is a very different animal. And how do you organize the company to do that? So that's super valuable experience. And then on the other axis is success, failure, right? Which is if you've experienced both success and failure, both of those things teach you super valuable things. What should you do and what shouldn't you do? And all of those things make you more, one, empathetic towards founders, and two, a better diligencer, if you will. In other words, the set of questions that you will have about, you know, is this the company that we want to build back? Is this the market that's big enough? Is the go-to-market plan make any sense? You have a set of experiences that sort of inform those questions. And so I would say those are the kinds of things that we were looking for. Embed yourself in the startup community. Make sure that you're getting a set of operating experiences, like working at startups, and then make sure that you sort of just stay intellectually curious, right? Startup by its nature is, you know, a lot of people are inventing something from nothing, right? And so you need the intellectual curiosity to sort of follow them where they've landed.
Yeah, incredibly helpful. Thanks so much.
Yeah, for sure.
Awesome. And we have time for maybe 1 or 2 more questions, probably just one, if anyone. Okay, Chad.
Hey, just curious, what is the a recently like funded portfolio company that you're extremely bullish on?
So I'd probably have to say Clubhouse, which is, you know, look, a lot of people assume that, you know, we were done with social networking, right? Between sort of Snap and Facebook and TikTok, like there would be no more like new ways for people to congregate and learn from each other. And I think sort of Clubhouse is disproving that, which is like it's growing faster than you would have expected. And we love a lot of the dynamics of Clubhouse, which is like on Twitter, it was very easy to be snarky, right? You picked an anonymous handle, like, and you know, the culture on Twitter got very snarky very quick, that you could sort of like prove yourself to be more clever than the other person. But in an environment like Clubhouse, where everybody sort of like, you know, they're identifying themselves in general with their real identities, there's a real human voice on the other side. I think it really becomes a forum for bridging and bringing people to together and genuine understanding, as opposed to, let me see if I can say the most sarcastic thing I can in 140 characters, right? So there's a lot of the motion that is sort of, let's build each other up, let's understand each other better, as opposed to let's tear each other down and let's sort of be snarky and see who wins the most snarkiness points. And look, I say that with full love. We were investors in Twitter. There are wonderful uses of Twitter. It's a standard part of my information diet. But I think there is a fundamental thing about human nature where, like, if you're hearing somebody's voice, right, there's sort of a built-in civility and empathy that is sort of missing when we're just typing in a keyboard. Something in our lizard brain responds to the voice.
Awesome. So we have about 3 more minutes left. So we'd like to take the remaining time to just close out and also just make a few announcements. Thank you, Frank, for being here. It was very interesting. You did a great overview of the industry, and the work you do at Andreessen Horowitz is also very unique and inspiring for people who would like to pursue careers in venture capital.